Oh my gosh. Well, we have 3 o'clock. Welcome to the Oklahoma City Post-Employment Benefits Trust here for November 13th. Call the meeting to order. We have item number 2, which is approve the minutes from our August 12th, 2024 meeting. I'd entertain a motion in a second. Please record your votes. Motion passes. Item number 3. We have multiple items here for items for consideration. We'll do each one of them individually. Item A is elect a vice chair trustee to preside at trust meetings and perform trustee duties in the absence of the chair.
Mr. Chairman, I would like to nominate Amy Madera to be vice chair.
We have a motion.
Next calendar year, or I should say, beginning next meeting.
A motion and a second. Please record your votes. And the motion passes unanimously. Congratulations,
She didn't
Amy.
speak up fast enough to say, I'm not doing that.
All right,
Thank you
now
all.
we have item 3B is receive our quarterly investment report for the period ending September 30th, 2024. And we have Jason Pujols with
Thank you,
ACG.
Mr. Chairman. First of all, I'd just like to say good afternoon and thank you for your confidence in our firm. A lot of familiar faces, and new ones here, but we're very pleased to continue our relationship with the City of Oklahoma City and working with you on the OPEB Trust. Today with me is Patrick Miller. He's one of my colleagues, works on the institutional team, working with public pension plans at ACG. He's going to go through the quarter report. Your performance has been outstanding. We'll go through that and just kind of orient you to, most of you are familiar with our reports, but orient you to our report, touch on October, and then I'm going to finish up with just some comments and our observations on your portfolio structure and just some thoughts that we have and takeaways. So I'll hand it off to Patrick.
Great, thank you. So it's good to meet you all. Again, as to echo Jake's comments, thank you for placing your trust in ACG. So before I get into the report, I do just want to make a comment on the transition. So of course, working with Mariner, formerly ANCO, and Bank of Oklahoma, we had to get a lot of data from both of them. And both Mariner, Jeff Perniske, and Doug Anderson were very responsive, getting data that we needed to create accounts and get all the information we needed in order to generate these reports that you'll see today. And then working with Karen Galvin at Oklahoma City, or Bank of Oklahoma, she's also provided us access to your third party, as a third party, viewing access to your bank account, and we're getting a daily transaction feed to be able to record all of the information for your financial transactions. So want to thank all of them, and everything's gone smooth with that transition. With that, I'm going to get into the quarter report as of September 30th, 2024. So I want to stop on this slide. If you look at, we've got performance for different market indices as of September 30th, 2024. First column being year to date, so the year of 2024, we've had strong performance really throughout markets. Looking at that gold bar, the one that's a little bit above 20%, that's the S&P 500. So US large cap stocks have really led the market over the last, in 2024 through the first 3 quarters. And right next to that is that purple bar being the Russell 2000 small caps, and then international stocks are to the right of those. So all have done well, posting double-digit returns. Looking at the one-year column, even stronger, where US large cap up 37% or so. And one thing that we've been seeing in the first half of 2024 and parts of 2023 was, you've probably heard the Magnificent Seven leading the markets, stocks such as NVIDIA kind of driving a lot of the performance for the S&P 500. And we've started to see a bit of a reversal with that in the post-June, really. And for example, and also the last few weeks, for example, with the one-year return, if we were to look at US large cap and US small cap stocks as of yesterday, the one-year return for small cap was 42%, so the red bar going above the y-axis here, and then the gold bar, the S&P 500 up 38%. So over the last year, as of yesterday, US small cap stocks are now leading US large cap stocks. So it's good to see that added breadth where it's not just the handful of large companies leading the market. And it also preaches the importance of diversification, which this portfolio has with not just exposure to the S&P, but you have small cap, international equities, et cetera. And then looking out to the far right, we have 10-year column. Again, the last 10 years have been kind of driven by the S&P 500. S&P 500 having strong returns. The U.S. economic growth has been great, and but then also small cap equities and international equities having strong growth for the long term. And it's bonds that have been lagging over the last 10 years. We've had 10 years of low interest rates. But then a couple years ago, interest rates go up, Federal Reserve trying to fight on inflation. And so go forward picture for fixed income is a bit rosier. We're getting higher yield on our income. And for the last year, it's really been strong economic growth that has led these strong returns. The Fed has increased interest rates, as I mentioned, to combat inflation. But while they're doing that, there were concerns, there were fears that could lead to impacting the labor market and cause a recession, but that hasn't been the case. Consumers have been resilient, they've been spending, and so the labor market has stayed strong, the economy has stayed strong, and therefore market returns have also been strong because of that. Now, flipping down here a little bit, one thing the Fed has started, the Federal Reserve, is lowering interest rates. Because inflation, they've been trying to tackle that for the last year, or for the last couple of years by raising interest rates, but now they've started to see it come down. Even just this morning was the October inflation report, came in at a little bit higher than last month on CPI. But then if you strip out the volatile food and energy, it actually was the same as last month at about 3.3%. So above the target that they want to be at, but it's still been coming down steadily for the last year and a half or so. So because of that, they're now starting a rate cutting cycle. So they're lowering interest rates because inflation job's kind of over and they don't want to keep them too high for too long and potentially impact the labor market. So you can see in this chart, this is the interest rate term structure. So on the left side are short-term interest rates, and the Federal Reserve controls an overnight rate, and they, in September, lowered it by 50 basis points. That's why the green bar, which is as of September, is a little bit below those other two bars, which were the quarter before and the year before. And then just last week, they cut rates a further 25 basis points. And because inflation came in again at about the same as last month, and markets are now anticipating next month, December, to be another 25 basis point rate cut. So these historically have been good for equities. So if I don't have the chart here, but looking from 1980 to now, every rate cutting cycle we've had, on average, US equities have benefited from that. And we started to see that benefit within small cap and large cap. And actually, like I said, small cap now leading large caps. Small caps are more economically sensitive to the economy. And then also interest rates. They have typically more floating rate debt on their balance sheets. So that's another reason we've seen some of the strong performance recently with US small caps. Now, the one thing since September, so that green line kind of hovering around 4% in the longer term. Since then, we've had strong economic data, such as GDP coming in at 2.8%, projected to be 2.5% next quarter, and then also some strong jobs reports. Inflation expectations, interest rate expectations have kind of shifted up. So while they're cutting rates, the expectation is they're not going to cut as much as they thought they were going to cut in September. So if we were to run this line as of October, the line would be a little bit shifted up, but the short-term rate is still expected to come down for the next few Fed meetings when they lower short-term interest rates.
Before you leave that, Patrick, because the OPEB trust, your liabilities are very long-term. So while short-term rates are coming down, the other thing we have seen is intermediate to longer-term rates. Since the Fed started cutting the short-term rate, intermediate to longer-term rates have gone up. So this chart at the end of September shows the 10-year at 3.78. As of this morning, it was around 4.4. So up about 60 basis points. That's almost a 25% increase. And one of the things going on in your portfolio, while having a lot of exposure to U.S. large cap, particularly relative to peers, has helped this portfolio on a relative basis. you've got some strategies on the fixed income side that are very sensitive to rate movements and introducing a lot more volatility, and having that 10-year going up 60 basis points the last month and a half has had an impact, a negative impact there over the short term. And we'll talk about that in a bit.
Yep. Yeah, any questions on any of this that we've covered? I'm going to jump into the portfolio, a few comments on the performance, and then Jason, as you mentioned earlier, is going to make some comments about just different asset classes in the portfolio. All right, great. So moving down here to total portfolio performance. So we have a scorecard here, just the last 5 years and the last 10 years. As Jason mentioned, performance has been very strong. You have a diversified portfolio with a 60% target to U.S. equities, which have done great. And so you can see that in these numbers, a 10% annualized return over the last 5 years, 8.3% annualized return, so that's 8% per year over the last 10 years. And that's exceeded the actuarial rate of return. It is behind the policy index, which is that last bullet, and that's, as I'll kind of point to in a little bit, well, actually you can see at the bottom in the footnote, 60% of the policy index is the S&P 500, but the portfolio isn't, it's 60% allocation to US equities, but not 60% S&P 500. There's small cap and mid cap exposure, so having that difference with the policy index, you're going to have variance, and in this case, S&P 500 has done so well, so it's a little bit behind because of that. But again, strong performance and ahead of actuarial rate of return. So asset allocation, looking at as of 9/30, so these are all of your targets. So US equity, non-US equity, core bonds, high yield, and active duration is what Mariner's report said. We just don't have that label in our system. So, but you have $113 million as of 9/30/2024, a 78% actual weight to equities versus 70% target, 21% weight to fixed income versus 30% target. And the US equities, because of the strong performance we've seen this year, are actually just slightly above the max range. So we're going to be working with the trustee's office to provide a rebalancing recommendation there, and putting a little bit of the equity exposure into fixed income, which is a little bit underweight the target. Now, looking at the dollar growth, so looking at the 3-month column to start, started the year at 108 million. Just in September, actually pulled $2 million from the S&P 500 fund and transferred to the cash reserve fund that needed some cash raised. And you can see the dollar growth that we've had from really, this is just the last 3 months. Excuse me, I think I misspoke earlier. Year to date, started the year at 102 million. And you can see the 2024 growth ending at 113 million. And then just looking at long term, 62 million, return on investment of 43 million over a 5-year period, and it'd be even more looking at 10-year, for example.
Patrick, can you go back to the target allocation page?
Yeah.
I'm going to just tie in some comments here to some of our observations, really with respect to policy. So these targets and ranges that are laid out here are what the targets and ranges are in your policy. So you have a target of 60%, as Patrick said, to US equity. Large cap and small cap really aren't defined in the policy. One of our comments is our preference would be to be a little bit more specific there and identify the target to large cap and identify the target to really non-large cap or small to mid cap. On the fixed income side, you're very precise. You do have targets to high yield and long government or active duration. There are some of our comments there, just because you have so much equity market volatility in this portfolio, you're taking on a little bit more volatility from the fixed income than perhaps is necessary. So our preference generally, and I'm kind of killing the punchline here, would be to allow active managers that have a more dynamic approach to make those decisions on allocating to high yield or increasing duration and consolidating some of those more single strategy components of your fixed income together. So.
Yeah, no, and that's a good segue into one of the other slides down here. If we look at risk for the portfolio, so as Jason mentioned, because within The bond fixed income, we have a 30% target there, and 9% of that is the long duration bonds, and then 3% of that high yield bonds, which are going to be more volatile than traditional core bonds such as U.S. Treasuries and investment grade, corporates. So volatility relative to the policy index, and here relative to some other public plan peers, just being a little bit higher. But again, of course, the return has been good because there's also that high allocation to U.S. equities. And again, same story for the 10-year.
So Patrick?
Yeah,
So could I clarify, when you look at these type of graphs, the goal is to be in the upper left-hand quadrant, right?
Correct.
That's preferable, yes.
Okay, that's
More return and a little bit less risk.
Right, more return, less risk. Okay, I just wanted to clarify that.
Yeah, correct. So yeah, we've got return on the y-axis and standard deviation or risk on the x-axis. So the higher you are, higher return. Left, lower risk. So portfolio, looking at these figures here being A, so higher risk than policy index and some other public peers. But this portfolio, for example, doesn't have the cash outflows that some other public pension plans might need. So there's the ability to take on risk, and that's why the policy is higher. But relative to policy, we think there's ways to diversify some of that risk while still being higher risk return profile than some peers of a similar size. And this can also kind of be illustrated here, just looking at the down capture. So one kind of bias we have with our investment philosophy is to capture less of the downside. So in other words, let me just explain this. Down capture 106, this is saying if the market or the policy index were down 10%, on average, the OPEB trust would be down 10.6%. We'd like to see that be more, 95 maybe, so you're not capturing as much of that downside. And we're willing to give up some of that up capture in order to reduce the downside. So getting some consolidation, which Jason will talk to with the high yield and long duration, could potentially help on the downside.
So the goal is to reverse those two.
Correct.
Maybe
Correct.
not reverse. Ideally, you'd have 106 up capture and 93 down. That's probably not realistic.
Easier said than done, yeah.
But the up capture at 90 to 95%, we're good with that. We're participating in the up markets, but we're protecting a little bit more in the down markets. And it's just some things on the margin. Ultimately, long-term liabilities, volatility, it matters some. And it's more conceptual, but we think you can get a little bit more efficient allocation of assets to protect a little bit and smooth the ride a little bit more over time.
And that's all I had on the quarter report. Do you need to approve this, or should I move on to the next?
Okay, we'll just go ahead and you can go to the C, and then we'll receive all of them at one time. So, A, B, or B, C, and D.
Great. It'd be the October. Oh, sorry.
Right, just B and C.
If you go to the October one, 1024. So here, just an update. There's really not a whole lot to go through. I'll just mention what this is. So every month we have our market snapshot. I've talked about a lot of these already. GDP growth coming in at 2.8% for the third quarter, and then talking about jobs report from the prior month, September. We've had October since then, we also just show market returns and typically have something relevant to what's going on in the market. This being stale now, as of October 31st was when this was published. So we had some on volatility where prior to elections, volatility kind of picks up, there's uncertainty. But then, post-election, oftentimes people, realize what's going to happen now, and kind of the uncertainty goes away.
So were you surprised, once the election was determined, are you surprised by the, what has happened in the markets, or was it expected?
Well, the reaction.
I think it was expected that with this result, that particularly the broadening out, you're seeing financials and some of the more areas that have been highly regulated, expectations that a little looser regulation, tax policy not changing, that's helped the market in the short term.
Okay.
Although, as you know, Brent, what we would say long term, the results of elections and what party's in control, it historically hasn't had a big impact for long-term investors. Everything looks about the same. in the short term, there's probably some,
Yeah, and
we're seeing a little bit more fuel in the markets. The one thing I'd point out on this page is the center section, which are relative valuations. This isn't intended to say we need to get in or out of something. It's just we're comparing each of these asset classes relative purely from a valuation standpoint, where it stands relative to the last 15 years. And not surprisingly, U.S. large cap, from a PE standpoint, is expensive. It's been expensive for about 2 years now. That said, U.S. large cap has continued to do pretty well. But as we just look at the overall asset allocation, like I said, having a little bit more specificity to large and small and non-U.S., something that we would propose doing, not necessarily changing dramatically the weightings in the portfolio. As a U.S. investor with liabilities in dollars, you're going to have more in U.S. large cap than anything else.
yeah, and also just to back up a little bit too, I wanted to point out, Brent, to your question, I never would have guessed which direction markets would go after elections because it's hard to say, but this chart kind of does imply volatility typically goes down after elections, and volatility and stock prices are inversely related. So better chance than yes that they would have gone up, but never would have been able to know for sure, obviously. And so this is just the October report, though. So as of 10/31/2024, and we had a total portfolio market value of $111 million. As we just mentioned, markets have done well the last couple of weeks. So I don't know what the market value as of yesterday would have been, but a bit higher than the September, for example. And allocations, same story really. We're going to be bringing a recommendation to lower that that equity target. So there's really not much else to go through on these reports.
So if you could go back to where you're saying we're overvalued in equities or large cap. So the plan would be to harvest some of those values because if you go to the next
Go back
slide.
to the next.
And then what do you,
Oh, yeah.
and then you're probably going to get
So
into this here in a second.
you're underweight to fixed income. And from a strategic standpoint, fixed income is intended to dampen volatility, provide protection. And you really don't want to run too far away from your targets.
Right.
And you're way overweight to equities.
Right.
You're almost at 80% equity. So we would work with the Treasurer's office. I think that's operationally how it goes, just to reduce the equity exposure. And it would be coming from, we don't break it down here, but some of it from large cap and some of it from the mid cap managers, and reallocating that to fixed income to bring that, we could bring that to target, basically. So bringing U.S. equity down 5 or 6% and adding to fixed income.
Okay.
And that doesn't take board action, I don't think. It's just your policy is your policy, and we want to get closer to that. So if you could just turn, and I've probably given away everything that I'm going to talk about, but if you'd go to the portfolio discussion piece, I think it's helpful just to put it in terms
If we
of.
could for a second, could we just go ahead,
Yep.
just to take care of this? On B and C, I'd consider a motion to receive both the B and C.
Let's do them separate.
Okay, we'll take separate motions for item 3B to receive the quarterly investment report ending September 30th. Motion and second, record your votes. That motion passes. Now for item 3C, to receive the quarterly reports for August, September, and October of 2024. And that motion passes as well. All right, now we're to D. We'll talk about the portfolio. Go right ahead. Jason.
Okay. I can control this. Just learned this after 15 years in this room, that I can control the mouse. Had no idea. So we put this page together kind of just to talk about how your portfolio is implemented versus what our general philosophy is by asset class, and then some comments and considerations that we would propose. First thing is with respect to investment policy. As I've mentioned, our preference would be to be a little bit more specific with a large cap, small cap. Also in non-US to develop versus emerging. Today, you don't have dedicated emerging markets. That might be a different asset allocation discussion. But if we were to have that, being a little bit more specific around targets there. So that's something that we would come back to at the next meeting with. I think at that time we will also, at the beginning of the year, each year we update our intermediate and long-term capital market assumptions. Intermediate term for us is the next 10 to 15 years. Long-term is 30 plus. Similar, OPEB trust, similar to the DB plan, you have very long-term liabilities, so we want to look out over longer time frames. So we put some asset allocation in here just to illustrate some things. I think we want to do it more officially at the beginning of the year when we update our capital market assumptions. So then we look at each of the strategies and asset classes that you have and how you're implemented versus kind of our thinking. Large cap, you're entirely passive through the Fidelity S&P 500 Index Fund. We like that. We believe being passive in large cap is appropriate. It's very difficult for active managers after fees to outperform over time. So we're comfortable with that implementation. Again, you don't have a target to small to mid cap, although you do have 3 investments within your U.S. equity portfolio or composite. 2 mid-cap strategies, Hotchkiss & Wiley Value, and then the Vanguard Mid-Cap Index, and then the third piece is a small-cap growth fund. Our preference in non-large cap is we typically don't do dedicated mid-cap, and the reason why is you generally are getting a lot of overlap with your large cap allocation with dedicated mid-cap strategies. And you'll see here in the considerations to the right, that Vanguard Mid-Cap Index, 256 of the 308 stocks in that index are in the S&P 500. So you're really getting, large cap stocks of the S&P 500 has been the best place to be the last decade. You have more than that than I think you probably have anticipated that you have. Even in the Hotchkiss & Wiley strategy, which is value-oriented, more concentrated, it's an active strategy. A little less than half, but about half of those stocks are in the S&P 500 as well. So our preference there would be to have more pure small to mid, further down in the market cap spectrum. Stevens on the growth side, we like Stevens. Our thinking would be to potentially add a complementary small cap value manager to that and take away that mid cap exposure that's really doubling down on large cap. In international developed markets, you have a single manager. You do have a 10% target to non-US. As we think about the global equity market cap, you are pretty decidedly tilted toward the US. Global equities are about 60% US, 40% non-US, and you've got about, you're 60-10, so that's more like 95-5 in terms of your weighting to international. Our thinking would be if we did some asset allocation work, probably bring up that non-US target a little bit and bring down US some. It's benefited you the last decade, but over time, we think having a little bit more non-US exposure makes sense. From a manager standpoint, we really like Causeway. They're a great manager on the value side. We would want to complement that with a growth-oriented manager. And then we mentioned emerging markets. I think that's something that we look at depending on how you implement. The Causeway has a little bit of emerging markets in there. Another growth-oriented manager may have some opportunistic EM. So maybe you wouldn't have dedicated emerging markets, but something we would want to look at. On the fixed income side, I've mentioned this a few times now. Our preference, you've got 3 different strategies, 4 different managers where you have allocations to. So you identify in your policy core bonds, which is DoubleLine and Loomis. we're comfortable with that nomenclature for the calling them core bonds, but both of those strategies have a little bit more flexibility than core. Core means U.S. investment grade only. They have the ability to have some non-U.S., some emerging market debt, high yield, floating rate debt, bank loans, and we like that in those types of strategies. And the DB plan, you know, we have that with Western, who we're talking about tomorrow, for those of you in that, and then PGIM and others. They're more flexible mandates where you're allowing the manager to go where they find value within a certain duration band. The active duration and the high yield, for a portfolio this size, particularly the active duration, our opinion is it's just adding significant volatility from fixed income, which we don't necessarily think you need to have with a 70% equity exposure. Same from dedicated high yield. At this size portfolio, if you were to roll these two strategies into Loomis and DoubleLine, I think the target to high yield in the policy is 3%. The actual high yield in Loomis and DoubleLine, it would be 3%. You would have that. So you really have more than 3% today in high yield. So our recommendation would be to simply roll those two strategies. You don't have to add any new managers, just rolling those two dedicated strategies into Loomis and DoubleLine. And then finally, we mentioned real estate. We know today that, and historically, this portfolio has been 100% liquid market assets through mutual funds. You know, as it grows, potentially something to consider is private real estate for diversification purposes. And you know, our philosophically, we like to see somewhere between a 5 to 15% allocation to real estate. The purpose of real estate is to provide a premium income return to bonds, where most of the return is coming from operating income or rents, with less volatility over time than equities. And it provides nice diversification benefits. That's something we can talk about later with asset allocation, but we just wanted to mention that. So if we look at the next page, this kind of boils it down in some bubble charts. As I said, we would propose moving these two strategies, just eliminating them and reallocating that into these two, removing the mid-cap strategies, and then adding a small value strategy. We kind of made this all look like it's small cap, but it's not. Having a small value strategy to complement the small growth, and then adding a growth strategy over here. I think these two things are more asset allocation questions to be addressed later. So I think this could probably be done now just through rebalancing. These pieces are more of a discussion we'd have to add other managers. We did want to show this just to thinking through from a modeling standpoint what a little more defined diversification can do. This is using our asset allocation tool. What we're showing is based on our capital market assumptions, not your actual managers, but these are our forward-looking assumptions for risk and return and correlation, how your current portfolio targets, your current implementation would stack up against some modified portfolios. So your current target, as I said, is very broad. 60% to U.S. equity, 30% to bonds, and 10% to non-U.S. equity. What's in the gold there is the median return, so it's the 50th percentile probability over a 10-year period, that your current mix would deliver a 7.4% return with a 12.6% standard deviation. What's helpful here, I think, when we're comparing is the Sharpe ratio and the first percentile return, and I'll touch on that. Sharpe ratio is a measure of efficiency, risk-adjusted return. So when we're comparing one mix to another, we want to see that Sharpe ratio going up. The first percentile return is simply we're modeling out a range of potential outcomes. The 7.4% isn't necessarily what you're going to get over 10 years. That just means there's a 50% probability that the return of that target allocation will be 7.4% or greater. There's a 50% return that'll be 7.4% or less. The 1% is in any given year, there is a 1% probability that that mix could be down 25.4%, kind of a worst case scenario. So we look at that, and like we said earlier, we do like to look at risk and protecting a little bit more in down markets.
So when you look at this, you want a Sharpe ratio that goes up, and you want a first percentile return
That's going
percentage
down.
going down. Okay.
So the current, and it's not exactly the current, I'd say there's a little bit more, we put more in small cap than you don't really have 26% in small cap. You have 26% in the mid cap managers and a small cap manager, but a lot of that is large cap. But there's a higher expected return from current because you're at almost 80% in equities. You're deviating from your target, but what you'll also see is the risk is higher. So this is why we rebalance. Your current risk in this portfolio is a lot higher than what you're intending. And so the potential downside is worse. You probably would say, well, if we're down 25 or down 27, it's still bad. But the point is just to show relative differences. So that's why we want to rebalance. You have a systematic plan of rebalancing back to targets. We don't just let the portfolio run. Then what we tried to do is just show some potential alternatives. Mix one is simply defining a little bit more the large and small, and also getting the U.S., non-U.S. a little bit closer. You'd still have 45% of the portfolio in U.S. equities, 25% in non-U.S. This is a little bit closer to the global opportunity set. What that does relative to your current target, it actually improves the 10-year median return, or the 50th percentile probability, and it lowers the risk. The expected risk actually comes down from 12.6 to 12.5. It's a little bit more efficient portfolio, thus a higher Sharpe ratio, and the first percentile return comes down a little bit more. Mix two, we just introduced dedicated emerging markets. If we took the 25% in international developed and added 5%, it really doesn't move the needle much. Probably doesn't, from a modeling standpoint, really make the case for dedicated emerging markets, because it improves the return by 5 basis points, but it increases the risk a little bit and doesn't move the needle on the Sharpe ratio. But then the last one, we show what the introduction of real estate does. So it's we're actually taking 5% from equity and 5% from fixed income, because what we would expect over the long term is real estate, higher return than bonds, lower risk than equities, provides some diversification benefits that actually bumps up our expected return, lowers our risk, portfolio volatility even more, and lowers the first percentile return a little bit. This is really for illustrative purposes, but more than anything, we think just on the margins, even mix one, having some definition around that going forward, even in a fully liquid public market portfolio, it improves the risk reward a bit. So kind of just trying to deliver our philosophy in a couple of pages to you. We know you've done well. The portfolio has done really well over the last decade. We don't need to come in here and make a bunch of changes, but we do have, we also think you've probably let it run a bit because it's done so well away from targets. So making some of those changes back to your current targets more immediately, we think is appropriate, and then we can talk about these other things at our next meeting.
Okay. So you're going to rebalance based on the current policy, and then you'll
Yes.
come back in first of the year,
And we'll talk
and
about
we'll talk
other
about whether we need to go out and
strategies.
get,
Yep.
okay, sounds good. All right, any questions for Jason? All right. That was just presentation, we don't need to act, and so thank you, Jason.
Thank you.
Now we're to item E, is receive the calendar year 2025 meeting schedule. There's for February 12th, May 14th, August 13th, and November 12th. I'll entertain a motion. Motion second, record your votes. Passes unanimously. All right, now we're to item 3F, which is joint. We've got 5 items related to health insurance. And we have Jason Long from HR here, so to answer any questions. So the first one is item F. It's a joint resolution approving Amendment 3 to the Master Services Agreement with Premise Health Employer Solutions. I think I'll stop right there. So I'm reading the entire thing. So I will entertain a motion on that item. Passes unanimous. Item 3G is joint resolution authorize renewal number 1 of agreement with Dearborn Life Insurance Company doing business as Blue Cross and Blue Shield with a cost of about $1.3 million, effective January 1, 2025. I'll entertain a motion for item G. Item G passes unanimously. Item H is a joint resolution with the MFA and the City of Oklahoma City approving renewal number 1 and amendment number 1 of the Administrative Services Only Agreement and Stop Loss Insurance with Blue Cross Blue Shield. Estimated costs $95 million, effective January 1, 2025.
$95 million. Holy cow.
Is that correct, Jason?
I was going to say, that can't be right.
That's 95 million total between OCMFA and OPEB.
Okay.
Yeah.
That's a significant amount of money there.
Just for retirees, that's crazy.
And that motion passes unanimously. Item 3I is, again, a joint resolution authorizing renewal number 4 of the Administrative Service Agreement with Blue Cross Blue Shield to provide dental care insurance for eligible employees and retirees at an estimated cost of $3.85 million, effective January 1, 2025. And the item is approved unanimously. Item 3J is a resolution authorizing renewal number 1 for the contracting with United Healthcare on behalf of the city to provide Medicare Advantage service plans for eligible retirees and retirees of participating public trusts. Estimated cost $3.5 million. That item passes unanimously. All right. Thank you, Jason. Item K is to ratify the claims from August 7th, 2024 to November 5th, 2024. Do you have any questions regarding the claims? All right, we received the motion in seconds. Record your votes. Passes unanimously. And then we have item 4, or comments from any trustees. Neil, Amy, Laura?
I will take a moment, sir.
Yes, ma'am.
This being my last meeting as vice chair and my second to last meeting on the OPEB Trust, being an original trustee of the OPEB Trust, pardon my language, but I'm damn proud of how far we've come with this particular endeavor. You know, when we took this on in 2008, it seemed like an extremely high hill to climb. And we had to make some very difficult decisions in order to make sure that our post-employment benefits were sustainable for all of our current and future employees. And we did eliminate some for future employees, but we did make them sustainable. And as a soon-to-be retiree, I hope to experience the benefits of that. Jason, I'll be calling you real soon about getting a layout, how my retiree benefits have to go. But I just want to say that it's been my pleasure to serve on this trust, and hopefully all of you will continue to carry forward this important work. So thank you.
Thank you for all your hard work on this. I know that similar to another trust, when you put the money in initially, we didn't do very well, right?
Yeah.
And,
We had a moment of like, holy cow, what were we
yeah,
thinking?
so, but,
Yeah, 2008, ooh, the good old days.
yeah, the good old days. We're-
Here too.
Yeah.
You've recovered from that, so we're doing well. I would bet if we were at $111 million at the end of October, I'm sure we're well over $111 million today, so,
I had
so thank you.
113, but maybe.
We were
that was-
113 in September,
Oh,
it went down
dang.
1% in October.
Dang, I
October's
hate
not a
when
good
that
month,
happens.
so,
Yeah,
so.
gotta
all
be
right.
better, right?
Well,
That's it.
Well, thank you for your service and your leadership on all of this, so, all right, Amy?
Yep, I just wanted to thank Trustee Johnson just for her service, and I will do everything I can to be able to live up to the expectations, and I appreciate the nomination from the board. Thank you all.
All right, seeing we reached item number 9 here at 3:45, we are adjourned.